In this week's episode of the Stockscores Market Minutes, I'm going to show you how to predict a stock market correction. I'll then do my regular weekly market analysis. We'll run a Stockscores Market Scan and look at the day trade of the week on QSR. All right, so with the weakness in the past few days, I think many people are wondering, is there more weakness to come? Is there a major stock market correction on the way? What I want to show you is how to predict that. Corrections will start with breakdowns through support. And usually a correction follows an upward trend, and therefore the break of support is the break of an upward trend line. Now, shorter term time frames will break first. Longer term time frames break, and they're also more important, but they break later. Typically, we see increased trading volume with these breaks of support, and that shows investor panic, and those are the breaks that are most important. Now let's take a look at some charts, and I'll emphasize this. So first, we're going to start off with the very short-term time frame for the market. This is the last 15 days, 15-minute chart of the S&P 500 ETF. And if I draw a trend line very simply, you can see it was first broken there on July 30th. However, there wasn't really any major volume. It was pretty orderly, and so that's not really a major concern. I can then draw another trend line across that, and you can see that that was broken late in the day on July 31st. And now look at the volume that came in. Now that was on the US Federal Reserve decision to lower interest rates, but also hinting at maybe there wouldn't be more interest rate reductions in the near term, and that caused the market a lot of concern. Now, as often is the case, we had a little bounce back as the bulls second-guessed the weakness, and it came up to the downward trend line, and that's exactly where it got stuck. And then we had our confirming signal right there on August 1st, which was, of course, when President Trump put out his tweet saying there would be more tariffs on China, and that caused a more significant sell-off. So it started really here where the confidence of investors was broken. There started to be a little bit of panic. Now investors are, sensitive. They're cautious. They're sort of have their eye on the exit door because they've been shaken a little bit. And so when that next bit of bad news hit the market, there's more panic there, and that was what caused that breakdown that we had into the end of the week. Now we can now apply that to a longer term time frame. I can draw a line across the bottoms. There's the upward trend line, and you can see that that was broken on Wednesday of last week, and the volume was higher than most days prior. So again, that's the sign that more weakness is likely coming. We can then apply it to a longer term time frame, now the weekly time frame, and this is where you don't see a breakdown yet. We are still above the upward trend line. I could probably draw that a little better, maybe more like that, but either way, we're still above it. So on the longer term time frame, this of course is the weekly chart, no major concern yet because that line hasn't been broken. And then we can even go to a longer term time frame. This is the monthly time frame. And let's just look at some historical reference here. Here we had a very long-term upward trend line that was broken in 2001, and that led to a 2-year downward move. Then we had another upward trend line that was broken here on the monthly chart in 2008, and we had the financial crisis sell-off. But since that time, we have had this very long-term, consistent upward trend line, and we are a long way from breaking that. We do have more volatility in the last, say, year and a half. You can see that we went from pretty quiet volatility to much greater volatility, and that shows investors are perhaps a little more worried about a big correction coming. But there's no major breakdown on this long-term chart, and therefore long-term, medium-term, I have no worries. It's more the short-term time frame where we're seeing that signs of correction that probably won't last too long, at least until we see the break of the longer-term upward trend lines. All right, so let's get into this week's market analysis. We've already looked at these charts, but we'll look at them with a different context now. Here is our downward trend line. You can see the distance below the downward trend line that price currently is at. And that means that the market is heavily oversold, probably due for a bounce back, but still it's a bearish chart because we have falling tops. We have panic selling in some ways. And so I think that the market's probably likely to move higher in the near term, but it'll get to a point where the pessimism will come back in and we may roll over and see further weakness. So I think it's important to at least be cautious in the short term. Now looking at that long-term weekly chart, as I said, the long-term upward trend line is still intact, and if we saw a little bit more weakness and touched off of this long-term upward trend line, I would expect we would bounce and then move back up toward the highs. So I don't see any cause for major concern yet. Moving on to the Russell 2000, this is the daily chart of the small cap index. You can see that we have that pretty strong resistance here. We have broken that little cycle of rising bottoms. You can see that this low is higher than this. And so that's a break of the confidence. We were building in anticipation of perhaps a breakout. That's been broken. And so I think it's good to be a little bit cautious with the small cap stocks. On to the Canadian markets. Here again, you see that sell-off in the last 5-6 trading days where we started to break through some horizontal support, breaking down there, and that telegraphed this move that we've seen. Again, the market is oversold because the distance from the trend line down to where price is quite large, and therefore we're due for a bounce back. But until we break this downward trend line, we have to remain somewhat pessimistic in the short term. Longer term chart, no real sign of major breakdown here. You can see I can draw a line across there and a line across there. We've got a pennant pattern building. I think we probably come down, touch the lower boundary of that, and then bounce and move back up toward the highs. More or less a neutral to sideways chart. TSX Venture starting to show some signs that are encouraging if you like to play these micro-cap Canadian stocks. We've broken the downward trend line. We're now building a rising bottom, and if we can break through that 600 level on the $JX, that's the symbol on Stockscores for the index, we should start to make a recovery. It's been a pretty rough 4 months, mostly because cannabis has cooled, but with some strong earnings last week from Afria, perhaps a little bit of optimism will come back to the cannabis sector. We want to watch for that breakthrough 600 that could be motivated by strength in the cannabis group. All right, on to currencies. The US dollar broke out last week through that resistance level. We had new highs this week, but we closed kind of soft, but still the buyers are in control. But look what happened. Here's where we got stuck. And if we go all the way across, there is that long-term resistance that I've been talking about for some time. We've hit it, and therefore the market for the US dollar is going to take some effort to get through that level. I expect that we'll at least go sideways, perhaps even pull back over the next couple of weeks. Canadian dollar has suffered in the last 3 weeks, but still we shouldn't ignore the fact that the downward trend line was broken. That's a positive. Now we're pulling back. Let's see if we can make a rising bottom and then start to move up again. If we can get through that level on a move up, then we'll continue the recovery. So early stages of a recovery for the Canadian dollar, but it's going to take time. On to interest rates. Big move for the bond market this past week as the Trump tariff tweet made people think, well, that's going to hurt the economy. That's going to give the Fed more reason to lower interest rates. So we had all kinds of swings last week. First, on Wednesday, the market thought, well, interest rates aren't going to be lowered because the comments from the Fed indicated as such. Then Trump puts out a tweet where he says we're putting on 10% tariffs on $300 billion worth of Chinese goods. Well, now that's going to hurt the economy. Now the Fed's got to lower interest rates. It's so funny how the dynamic switches back and forth. But that is what motivated this big jump in the bond market, which meant interest rates fell lower. On to commodities. Of course, if the sense is that interest rates are going to go lower, that helps this thing, gold, move to almost new highs for the local area anyways. It recovered nicely. It was weak early in the week, but it came back to close strong. And that upward trend that started with this break of that little downward trend line there continues to be in place. I don't think you initiate new positions in gold names, but those that you hold deserve to be held still, as most have healthy charts. All right, on to the oil chart, and you can see that we have a downward trend line that is still in place. We also have an upward trend line, and we're getting to the pointy part of the pattern where eventually we're going to have a resolution. We're either going to break to the upside or to the downside, and really that's what you want to wait for to tell us where this oil market is going to go next. I think the bias is to the downside, but until I get a break out of this pennant pattern, I'm not going to call it either way. And finally, the fear chart. And of course, we did have a little bit of jump in fear this week. You can see here, there is that spike in the VXX, which is the fear index, and just shows the nervousness of the market. Not a big deal. We've had that happen a few times. You get these little cause for worry. I think it's going to pull back in the near term. I wouldn't chase after fear here unless we start to get breaks through important support zones on the S&P 500. So my rating's then neutral on the long term for US stocks. I just think that they're going to take a breather near term, bearish short term. Same thing for Canadian stocks. Still bullish long term for gold, but neutral short term as it is still kind of stuck inside a sideways range. Neutral long term for oil and bearish short term. Uncertainty about interest rates and China-US trade has brought out the sellers and increased the volatility that we see in the market. Long-term trends remain up, but we should expect more price volatility in the near term. There's that uncertainty there, a little bit of fear coming into the market. It's a good time to be defensive with stocks, but still watch for buying opportunities on weakness. Essentially, you want to sell the rips and buy the dips because the market is still in that upward trend. Gold is good, oil really isn't, and fear is rising. All right, let's jump over to the Stockscores Market Scan tool now and run a scan in search of opportunities. What I want to do is take a look at a number of charts and really just go through the analysis methodology for how you analyze the stocks that come up in the Stockscores Market Scan. So we'll jump over to the Market Scan now. I am going to run the Abnormal Breaks US scan. This looks for stocks on the US markets that made abnormal price gains with strong volume. Run the market scan. You can see that the scanner found 43 stocks. We're going to view these in the slideshow so that I can go through them a little more carefully and just analyze how I would look at these charts. So first up, Ballard Power. On this time frame, looks excellent. We've got rising bottoms, flat line of resistance. That is an ascending triangle pattern. We broke out through the pattern with strong volume. And on the daily time frame, it looks excellent. However, you always want to check the longer term time frame as well. And so I'd like to jump to the 3-year weekly time frame. And here's where you see a little bit of an issue because we're going to find some resistance right there at 4.5. So my expectation is we may stall, take some time to get through there, but on a pullback I do like it because I think ultimately with the trend being up, we can get up towards the 550 mark. So I think you just maybe be a little bit patient, don't chase it here, wait for the market to pull back and then start to move up again. Overall, the chart looks pretty good. Moving along, I just hit the right arrow key and I can go to the next chart. Here we have Ribbon Communications. What I like here is that the cycle of falling tops has been broken. We have good volume coming in from a rising bottom. You can see the bottoms are rising. That means optimism is coming in. This is a pretty good chart. My concern is that upside is limited to where that resistance is at about 620. And so, you know, it's got good upside, but when you think about risk, your downside is to here and your upside is maybe 1.5 times that. I like to see 2 times upside for the risk I take. And so it's a marginally good chart. This one, this is Afria, which I spoke about earlier, had a strong break to the upside on strong earnings. However, there was a lot of pessimism into that. And so all of these people that have been pessimistic are likely to sell into strength. And it makes sense because we're right at this resistance level that has been hit a few times. So my expectation is it will take some time for this stock to turn around. I think it pulls back, maybe works its way up here, and then perhaps makes a break later, maybe a week down the road, maybe a month down the road. But I would wait for that second break from a rising bottom. And even then, you're going to find strong resistance up here. So how much upside will there be for the risk you have to take? You know, there's lots of issues with this chart, and I would be careful with it. We'll do a few more here. Again, I like to always look for these breaks of downward trend lines. Those are good signs of reversal, but I do like them from rising bottoms. And you can see that this is from a new low. Even though the volume is strong and the price action is strong, I think it probably pulls back, makes the rising bottom, and then tries to go higher. Keep an eye on this one, but I wouldn't chase it here. Here's another stock breaking a downward trend line with abnormal price action, abnormal volume. However, not from a rising bottom, but rather from a new low, and that is a concern. Probably pulls back, makes a rising bottom, and watch for the break of a pullback after making a rising bottom. That's a better cue to entry. Let's look at a few more. That one's really nothing to say there. Here's a decent looking chart, and what I like about this is, yes, it's breaking the downward trend line with abnormal price, pretty good volume, but in this case, you've got some rising bottoms that are building. So you've started to get optimism. That means the psychology of the market is reversing, and that is a good sign for this stock to go higher. Issues, it's got fairly strong resistance right there, so it probably will get stuck here short term, but if it can pull back and then start to move back up through that 1250 level, I think it looks pretty promising. All right, that's enough for chart analysis. Let's go back to the presentation and look at the day trade of the week. So this is a trade that came up in the previous week. I like to go through the economics of the trade and just show you how my action candle indicator predicts these day trades. Obviously, these are all trades that have already happened. We can't do anything about them now. It's really just for educational purposes. But what I like about this one is it is a $75 stock. You can see there the price, $74.50. And it made our action candle right there. It had a nice pattern, really everything I look for, strong volume. My action candle indicator fires, find that stock right at 9:34 in the morning on Friday. But even though it's a $74 stock, because it made such a significant break, the capital required wasn't all that high. The position for $100 of risk was 110 shares. That means capital required of $8,209, but with margin you can cut that into a third, which means the actual money that you need to put out for this trade is $2,740. It ended up at the end of the day at 3 RR, which means it earned 3 times its risk. So if $100 was risked, it made $300 of gain. That is a 10.9% return for a one-day hold. These are the kind of day trades I love because you get a nice percentage return on your money when you can use that margin. All right, well, that has been the Stockscores Market Minutes for August 5th, 2019. Hope that you're enjoying the summer. Hope that you had a great week in the market. If so, please, if you like the video, please click on the like button, subscribe to the channel, and most importantly, trade well.